Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 22nd of March. I'm Daniel Lam, your host for the podcast. Over the last couple of days, the write-down of the Swiss financial institutions' AT1s has been the key discussion item. So let's discuss about them and the investment implications going forward. In general, AT1s rank higher than shares in the capital structure of a bank because bondholders rank above shareholders in terms of getting the money back. However, in Switzerland, the bonds terms state that in a restructuring, the financial regulator is under no obligation to stick to the traditional capital structure. Now on Monday, in order to reassure investors, regulators from both Europe and the UK stated that losses would be imposed on shareholders before bondholders in such scenarios. However, this did not prevent the price of other banks' AT1s dropping, as investors marked down their bonds, fearing that their investments may face the same fate under distress scenarios. It is likely that investors will be more cautious about buying AT1 bonds in the future, making it tougher for banks, which need to raise money in bonds market to meet regulatory requirements. So this is a headwind against European financials. Bottom fishing in AT1s is difficult at this moment in time, but when the dust settles, investors may consider AT1s from banks that have stickier retail deposits. Structured products on European banks appears to be interesting because volatility in the sector is high right now, giving potentially attractive terms on volatility selling structures. However, the US mega large cap financials, as we stated yesterday, may offer reasonable opportunities. Most of the large banks have stronger liquidity profiles versus the regional banks and have less exposure to unrealized losses on assets held to maturity. And many of them have much more retail deposits in their books, which tends to be stickier. They have exposure to businesses such as investment banking, which may benefit from rebound in M&A, ECM and DCM activities, and asset and wealth management, which gives diversified revenue base. Due to issues from weaker financial institutions, the mega large cap financials may be able to grab more market share and improve their longer-term revenue growth. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.